Hello and welcome back to the MCF Pre-Retiree Academy. In 1789, Benjamin Franklin wrote a letter to a friend in France just after the Constitution was established, in which he stated that nothing was certain but death and taxes. While that is certainly as true today as it was then, it also stands to reason that if we can lessen that tax obligation, why wouldn't we? After all, I tell clients that tax avoidance is legal and tax evasion is not. Proper tax planning makes it easier to build your personal finances and afford the things that you want. Additionally, by anticipating taxes, when you create your financial plan, it's possible to significantly boost how much money you'll have in retirement. Often when it comes to tax prep and planning, we as planners or investors utilize a CPA for this expertise, which leads us to our very special guest and valued team member at MCF, Natalie Schuler. Natalie is a CPA and a certified financial planner that joined our team almost 2 years ago. She has over 15 years of experience in public accounting and now uses her expertise in serving MCF clients with tax planning, financial planning, and tax preparation. Natalie, thank you so much for joining us today. So let's start with the basics. What is tax planning?
Yeah, so tax planning really involves analyzing a person's personal financial situation to make sure all the elements are working together to have the lowest taxes possible. And a plan that minimizes how much you pay in taxes is referred to as tax efficient. So tax planning should really be an essential part of an investor's financial plan.
Okay, great. What tax consideration should there be for those that are planning for retirement?
Yeah, so the first step is really looking at, what are your income buckets? You've got your taxable income and you've got some income that's not taxable. So it's really analyzing, what are those buckets and how can they work to your favor. So the first one let's talk about is Social Security income. So it's important to keep in mind that Social Security income is taxable, but not all of it is taxable. So the amount of taxable Social Security depends on what other income you have. So generally, if your total other income is less than $25,000 if you're single or $32,000 if you're married filing jointly, you pay zero tax on your Social Security income. If your other income is greater than $34,000 filing single or $44,000 married filing jointly, you pay tax on 85% of your Social Security income. And that's the maximum amount you can pay on. So the 85% is the maximum amount they'll tax on your Social Security income. Any amounts between those, 50% of your Social Security income will be taxed. So let's take an example. Say your other income is $50,000 and your Social Security income is $10,000. Because your other income is at that top threshold, you're going to pay tax on 85% of that Social Security income, or $8,500 of your Social Security income will be taxed.
How are tax-deferred vehicles such as traditional IRAs, 401ks, or health savings accounts taxed?
Yeah, when you take distributions from your traditional IRAs and 401ks, that distribution is taxable, and it's going to be taxable at ordinary income tax rates. Now your HSAs, that's a great vehicle to save now for medical expenses later, and those distributions come out tax-free if they're used for medical reasons.
What about taxable investments such as a brokerage account or a mutual fund, something like that?
Yeah, so a brokerage account, your accounts earn interest and dividends each year, and whether you take those out or not, those are going to be taxable to you. There's also the capital gains inside those brokerage accounts. Now, it depends on if those are short-term or long-term gains. The short-term gains are the ones that are held for less than a year. Those are going to be taxed at your ordinary tax rates. The long-term capital gains, those are going to be held for more than a year, and you get the favorable tax rates with those, that income. And the highest tax rate for capital gains is 20%.
What about Roth accounts?
Yeah, so your Roth accounts are a great tool because those come out tax-free.
So having different accounts with a variety of tax treatments could really be advantageous in order to better control your taxable income in retirement.
Exactly.
After I stop working and my income is potentially lower, how can I take advantage of say a 0% or a lower tax rate than your working years?
Right. So during the time between you stop working and when you begin taking your RMDs at age 72, there's a few opportunities. One of them is the standard deduction shelter. So the standard deduction is really high right now. It's about $13,000 for single, married filing jointly is $26,000. So if you're able to cover some of your other expenses with savings and other cash accounts, you may be able to shelter a lot of your taxable income, say from an IRA or a 401k, with the standard deduction. And income above the standard deduction starts to be taxed at 10%. So the key is to really look closely at your cash needs and determine how much above the standard deduction can be covered by a cash or savings account, which potentially could reduce your income to zero, your taxable income to zero. And like we talked about before, Social Security benefits, it's important to look at those and where those lie and where you're going to be hit with the 50% or 85% of that being taxable.
Is there an advantage to realizing a long-term gain while your taxes are lower?
Yes, so long-term capital gains are taxed at a different tax bracket. So you've got your ordinary income tax brackets, which we all probably know, the 10, 12, 24, up to 37. Long-term capital gains have their own bracket. So it's 0, 15, and then 20% is the highest bracket for long-term capital gains. And so if your income is low enough, at about $41,000 for single and about $83,000 for married filing jointly, if it's below those thresholds, your capital gains could be taxed at 0%.
I know Roth conversions also come into this category, but let's touch on that in a bit. While we're talking about deductions, let's talk about charitable deductions. Are there creative ways to reduce taxable income while supporting charitable efforts?
Right, yes. So if you're interested in providing charitable support, donating to a nonprofit organization with a qualified charitable distribution is a great way to achieve that. So qualified charitable distribution is a non-taxable distribution from an individual retirement account or an IRA directly to an eligible charity. So you must be at least 70 and a half years old to take advantage of the QCD strategy. For taxpayers who have reached age 72, the QCD can be used as part of their RMD, so they can use all of it or part of it, and it basically removes the income, that income piece from their taxable income. So if you're charitably minded and have RMDs, this is the best way to give to charity because it is a direct reduction of your taxable income. And QCDs do not prevent a taxpayer from itemizing. And so for tax rules around these, it's really best to talk to a tax professional.
Sure. Can there be a benefit to bunching donations?
Yeah, so bunching donations is a great way to get a tax benefit from your charitable contributions. So because the standard deduction is so high right now, many people are not itemizing and therefore they're not getting the tax benefit of their donations. So one way around this is to give 2 or 3 or 4 years worth of donations in 1 year. So in the year that you're bunching, you get receive the tax benefit of those deductions, and then the other years you'll take the standard deduction.
What about donating stock directly to a charity?
Yeah, so you could also consider donating appreciated stock or assets. So if you donate appreciated stock that you've held for more than a year, then you'll generally be able to claim a charitable tax deduction for the full fair market value of the stock. This approach saves paying the capital gains tax that would result if you sold the stock and then donated the cash.
What is a required minimum distribution, also known as an RMD, and how does the RMD tax penalty work?
So a required minimum distribution is the minimum amount you must withdraw annually from your retirement account when you are age 72 and older. It's recalculated each year, and if you don't take a distribution or if you take less than your required amount, you may have to pay a penalty equal to 50% of the amount not taken. So being aware of this ahead of time can help you avoid that penalty.
What are some tax savings moves that people can make before the age of 72?
Sure. So one thing to consider is converting taxable assets to a Roth IRA. This is especially helpful if you expect to be in a higher tax bracket when your RMDs begin.
So you're talking about Roth conversions. Explain that a little bit, please.
Sure. So a Roth IRA conversion involves transferring retirement funds from a traditional IRA or a 401k into a Roth account. The account holder must pay tax on the money when they convert it, but their withdrawals from the Roth when they take it distributions down the road are tax-free.
So the idea is to systematically convert tax-deferred dollars to tax-free dollars at lower income rates than possibly in your working years or in your RMD years, correct?
Right.
Are there times that this doesn't make sense?
Yeah, I don't think there's a black and white scenario that says if you have this much income or this much in assets that you should or should not do a Roth conversion. I think instead, realistically looking at your tax bracket now compared to when it will be when you're taking RMDs. So, if it's a difference between the 12% and 10% tax bracket, it probably doesn't make sense.
Sure.
But if your tax bracket now is 12% and you think you'll be in the 24% tax bracket later, I think it's definitely something to consider.
What else can we do prior to age 72?
Yeah, one idea is selling investments that have appreciated in value. So while your income's lower, take advantage of those lower capital gains tax brackets by selling those investments that have appreciated.
Okay. In relation to that, it's something advisors call tax loss harvesting. And this is where we look at each portfolio later in the year to determine if larger long-term capital gains can be offset against losses within the same portfolio or household in the same year. Lastly, it's always wise to revisit your withdrawal strategy because withdrawals from tax-deferred accounts are neither penalized nor required between ages 59 and a half and 72. So you have more flexibility and control with withdrawals for retirement savings. An advisor can help you create a plan and determine how much money to withdraw each year to meet your goals while managing your tax liability across the years of retirement. Planning by nature is usually something that is done in advance prior to something actually happening. Tax planning is a continuation of income planning, which is derived from savings. Savings is in part a result of budgeting, and it all comes from your desired income needs and goals in retirement. Understanding your sources of income and planning that income in the most efficient way is really what this is all about in order to limit your taxable exposure. Natalie, thank you very much for taking the time to talk to us today and giving us several things to consider. Thank you all for watching, and stay tuned as the next couple of weeks we will cover the importance of continuing to save as you approach retirement, as well as estate planning, which is always a hot topic. Until next time, have a great day, everyone.